The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Happy Friday, everyone. Good morning. You're listening to Money in the Morning with Mitch Goldberg. You are listening to 103.9 FM LI News Radio. Thank you so much for joining us. Thank you for giving us your time and for just listening to us. And we sure as heck hope we are providing value to you. Don't forget, you can follow us, LI News Radio, on Facebook. You can listen on the LI News Radio app. It works very, very well. Download it. Get that on your phone. Hit the triangle so you can listen to this station wherever you go. And I can tell you the programming is getting better and better. And I am very, very excited to be on the station. And I'm very, very excited to be with you this morning. So we're going to talk about a couple of things today, but first, this week sure as heck went by quickly. It's a down week for all the major averages, Dow, S&P, NASDAQ, small caps, mid caps. Not a severely down week. It's just a little bit down. We're still having a pretty good year, but investors are they're starting to wonder if maybe the rally this year has been too far, too fast. And is it all just basically on the January effect where investors finally stop selling losers in December for tax loss purposes? So the selling stops when we turn the calendar to January, and that takes away the selling pressure, and then stocks drift up a little bit. Then other investors get excited when they see stocks drifting up a little bit, so they commit money to buy stocks. And it just creates a feeding frenzy to the upside. That's the January effect. So is this year so far up for the January effect, or is it really a real rally? I can tell you this. I will say this with complete certainty. In a couple of years, we're not going to remember this market today. If it's your birthday or something, you'll remember it, hopefully. But I do firmly believe the market is heading higher. It's just, when will it head higher? And that's, they say the three most important words in real estate is location, location, location. The three most important words in the stock market is timing, timing, and timing. So I want to take the timing aspect of it out because it's hard. It leaves you open to making bad decisions. And I think you need to give yourselves a little bit more room for error and take some pressure off yourselves when it comes to investing. And if you want to follow up with anything, as you know, my name is Mitch Goldberg. That's why we call the show Money in the Morning with Mitch Goldberg. You can learn more about what myself and my partner, what we do, at ClientFirstStrategy.com. My partner is Bobby Bird, and you could check us out there, ClientFirstStrategy.com. If you want to take this conversation offline and follow up on your personal finance, you're welcome to give me a call. There's no obligation. I have spoken with a whole host of LI News Radio listeners these last few weeks. I'm finishing my third week of doing this show on the station, and I'm really tickled pink with how many people have actually reached out to me just to talk about their finances. And the majority of you have just called to ask about things. Should I do this, or what do you think of that? And they're just conversations, and there's no pressure. There's no obligation, and it's no big deal. If you call again and you decide to use us, great. If not, we're happy to provide value because that's the point of the show. Okay. It's to provide you value. So yesterday, the Dow was down 250. NASDAQ was down 120. That's 1% in dog years. S&P down 36. That's 0.88%. Gold was unchanged yesterday. Oil, was up a little. Oil is up today. We'll talk more about that. The yield on the 10-year Treasury is back to the 3.6s. And the VIX, that's the volatility index. I look at 20 as a major mark. It's 21.5. It's been in the high teens for a little while, which made people feel good. So when you see the VIX climb back to like above 20, it means worries, investor insecurity is starting to creep in. Technically, what it means is that large investors are starting to pay more money to hedge their portfolios. So it indicates a level of worry. And if the market plunges, for example, you'll probably see the VIX skyrocket. The BND, that's an ETF. That's the Vanguard Total Bond Market Index Fund ETF. I track this ETF because I use it as my proxy for how the bond market's doing. All right. And it is up 1.87% year to date, but in the last 12 months, it's down 10.7%, which is a real lot for the bond market. It just goes to show you that the bond market was down a lot and it's recovering a little bit. Nothing special. As a matter of fact, bonds lately are doing worse because you're seeing the yield on the 10-year Treasury go up. So when yields go up, that means bond prices are actually going down. So if you are an investor who's diversified with bonds, you're starting to see that portion of your portfolio go down a little bit, as well as the stock portion. So bonds just are not acting right now as a really great ballast to your overall portfolio. By the way, you can't invest, you can't invest directly into an index, but you can invest into a security that tracks or mimics an index. And diversification is a strategy that we use to mitigate risk. I just have to pound this in, okay? But it doesn't necessarily protect your portfolio from going down in a generally down market. So people say, but I was diversified. I'm still down. All right. Diversification helps. And if you're down, it helps reduce downside, potentially anyway, right? But if you're down less in the overall market, conceivably you should recover faster than the overall market. Right now, we're looking at a continuation of yesterday's down day. Dow futures indicated to be off about 100. S&P futures down 20. NASDAQ futures down 100. Oil is up about $1. Russia has said that they are going to reduce oil output by 500,000 barrels to 9.7 million barrels per day, which they say gets the market more in alignment. But we know that Russia is preparing a big offensive movement against Ukraine, and it's their job to inflict as much pain as possible on the rest of the world for supporting Ukraine, which we must continue. And that is the story over here. So stocks making big moves today include companies like Lyft. And Lyft is tanking down 31% today. So a lot of people decided to jump on Lyft because it's a competitor to Uber. Uber had phenomenal numbers. They had like the 2 billionth ride in the last quarter. And things are going really well for Uber. So investors jumped onto Lyft thinking that they will follow suit because the business is so good. But Lyft is down about a third, losing a third of its value this morning. And, that's the risk of investing when we jump into stocks. For me, when a company is like so close to reporting earnings, I prefer to wait until after the earnings announcement if there's a stock that I want to buy. Now, you could be in a position like Disney, what was up like $6-7 yesterday. But it's in better shape. I'd rather pay up a little bit for a stock with more certainty going forward that business is good, as opposed to buying right before an earnings announcement and the stock plunging. I know a lot of people talk about buying on earnings. I'm buying on the earnings announcement. To me, that is such short thinking, and it is so hit or miss that I'm still confused after 33 years in this industry as to why people are still trying to game earnings plays, especially now that the stock market has taken a pretty good rally so far this year for 1 month and a couple of days. that leaves less room for error. Okay, Yelp is up 5%. Cloudflare is up about 8%. Affirm continues to get pounded. The buy now, pay later stock. I never understood what was so great about it to begin with. I don't think what they do is so hard to duplicate. It's not a good sign, I think, when people are using Affirm. Newell Brands slumped 7.5%. They manufacture Rubbermaid and Yankee Candle. So that's the quick and dirty. You're listening to LI News Radio, 103.9 FM, Money in the Morning with Mitch Goldberg. We will be right back after these messages. We're going to be talking Roth IRAs, personal finance, taxes, and a couple of other fun things. Thank you for listening. Stick around. Friday, everyone. We are back. You're listening to Money in the Morning with Mitch Goldberg. We talk about recessions all the time, so I want to just get into a little bit about recessions. Are we or are we not going into a recession? My feeling is that it's looking more like soft landing than recession. And the Fed raises rates to tamp down inflation. The Fed's goal is to slow down the economy so that inflation goes down. If you reduce demand, it'll lower prices. Or if you could somehow increase supply of goods, that'll lower prices too. But with supply chain issues, we could tell how hard it is to raise supply. This was not the case before the pandemic because we had more of an intense level of global economic activity. And, we weren't having COVID shutdowns in China and all over the place. So, and supply chains were made for efficiency, not redundancy. It was just, you want to be lean and mean. You don't want to carry extra inventory. Manufacturers, suppliers, the whole supply chain is based on just-in-time delivery and doesn't factor in interruptions. And, well, COVID, obviously, the pandemic was a huge interruption, biggest we've ever seen in modern history. So we have to get into the mindset that as we build for more redundancies and we start having extra stuff in inventory, we start producing more things domestically, globalization has taken a back seat, and not for political reasons. It's really now done for supply chain reasons. It's the economics that ultimately will dictate all of this stuff, by the way, not the politics. The economics of the world have changed. And as a result, just things are going to be, I think, in a permanent state of higher prices. Now, inflation could go down to 2% and say, wow, inflation is low. But if you look at where prices were 2 or 3 years ago, prices are still very elevated. We're just going to live with these elevated prices, and hopefully they just won't continue to become even more elevated. That's really what the Fed is fighting for. Nobody thinks that we're going to go back to prices of goods and services to where they were pre-pandemic. So life has gotten more on a more expensive plane. That's the real ultimate big change. But with regard to recessions, I think one of the reasons why we're not thinking about recessions correctly anymore, or we should be thinking a little bit differently, is we have rolling recessions. It used to be, I feel like I sound like such an old man when I say that, It used to be that when you have a recession and the economy goes into a negative GDP, the whole economy acts as one single unit, like so homogenous. But the different parts of the economy are really just different. And you've got technology, financial services, energy. There are so many different parts of the economy that could hold up when other parts of the economy are doing poorly. And that's why I don't think a deep recession is anywhere near being on the table. I hear the fear mongers say, oh, you don't know what's going to happen. Sell all your stocks now. We're going to go down another 50%, or we're going to see the worst recession ever. And I don't buy the fear mongering. And if I thought, believe me, I would tell you. And it's not like, oh, you're in the investment business, so you have to be bullish. No, I could actually be in the cash management business too. Okay. It doesn't matter to me. Either one, they're both the same. My income wouldn't change either way. So I will roll with the punches and the way I see things coming down the pike. So that's why I think differently about recessions today compared to when I got into the industry in 1990. It's just different sectors are going to react differently. The other thing is when interest rates were zero just a year ago, the feeling was that, or a very scary thought for a lot of people in the investment community was that, well, interest rates are already zero. So what do we do if we go into recession? We can't cut anymore. But here we are now with the Fed funds rate at 4.75. We are all expecting at least 2 more quarter-point rate hikes. So we're going to be at 5.25 in about 11 weeks. All right. It's going to be, it's about 10 and a half, 11 weeks. We will have 2 Fed meetings under our belt, 2 more. And so if the economy does start to slow meaningfully and recession starts to become too big of a worry, we actually now have room to cut rates, which is not only good for the stock market, not only good for mortgage rates, for rates, mortgages going down, but that's stimulative to the economy. So at least we have the tools now. The worry a year ago was we don't have the tools anymore to fight off a recession. But we do now because rates are higher. The Fed has shrunk its balance sheet by about $600 or $700 billion in the last year. It's got a long way to go. Don't get me wrong. But the Fed's cutting its balance sheet by about $100 billion a month. And there's no sign of that stopping either. And right now, money is not that tight. Like if you want a loan, by and large, if your credit score is decent, you're getting a loan. You don't like the rate you're getting, but you are able to get a loan. You have access to credit. You haven't received a letter from your credit card company that says no more. You're cut off. I mean, if you have really bad credit, you're in a financial dire straits. That's a different story. But by and large, I'm talking for most of us. So I think we could put this fear of some kind of economic calamity behind us and start thinking that the Fed has tools to fight off a recession because rates have risen so much. And inflation is expected to come under control. It could go up a little bit more in the middle of the year. That's kind of the talk now. But by and large, I think it's very soothing to investors that the Fed at least is trying to get a handle on inflation as opposed to when it said inflation was transient a little bit over a year ago. Now the word is disinflation. So Jerome Powell uses the word disinflation, meaning the growth rate of inflation is moderating. So we were at 9, then we're 8, then we're 7, then we're 6, and hopefully we'll be at 4 pretty soon. So I want to talk to you about something a little bit more common. We've been talking about Roth IRA conversions. I'm a proponent of being as tax efficient as possible, especially in retirement, because it's going to be a big deal in retirement because it's not tax efficiency is not just a matter of more money in your pocket just from your general cash flow. It affects your Social Security and it affects your Medicare contribution, which could actually be pretty substantial. Now, for your Social Security, I think it's pretty much a done deal that we're all going to be paying taxes in Social Security because federal tax return as an individual and your income is $25,000 or jointly with a spouse $32,000, you're paying taxes on your Social Security. 85% of your Social Security income is taxed. I'm not saying they're taking away 85% of it, just 85% of it you're going to pay maybe 12, 20, 30%, whatever the tax rates are when you retire. Okay? I'm saying whatever they are because the Tax Cuts and Jobs Act sunsets at the end of 2025, and 2026, we go back to the tax brackets before that, which are all going to be higher. The other thing is when you do a Roth conversion is you owe taxes on that money. And if you're paying that money out of your cash, which is the best way to pay taxes out of your Roth IRA, you have to pay the taxes on the 15th day following the end of that quarter. So if you do a Roth conversion now, you don't have till next year to pay the taxes. You have to pay the taxes at the end of the March, 15 days after the March quarter, which is April 15th. Okay, if you don't, then you get hit with a penalty for underpayment of taxes, and it makes the Roth conversion even a little bit more expensive. And I see a lot of people getting tripped up by this. So it's important to know. Thank you so much for listening. I hope you all have a great, wonderful weekend. Enjoy the big game on Sunday. And you're listening to LI News Radio 103.9 FM. I'm Mitch Goldberg, your host. You're listening to Money in the Morning with Mitch Goldberg. And I cannot wait to speak with you Monday morning. Have the best weekend.
Securities and investment advisory services are offered through Next Financial Group Incorporated, member FINRA SIPC. ClientFirst Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and ClientFirst Strategy and not those of Next Financial Group Incorporated. Views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial Group Incorporated does not provide tax advice.